Hello, this is Rich Canleone coming to you from CME Group trading floor. Today's segment is going to be called Market on the Fence. Not only is the market on the fence, but I think from a trading perspective, you could actually take a position either way. There's nothing that stands out that suggests that you should be short, aside from the market coming back under 1300. And there's nothing that really stands out that says you should be long, aside from the bounce in some of the other ancillary indexes, like the NASDAQ, particularly the other day, that retested the 200-day moving average unchanged on the year. At any rate, the market focus, of course, has been still the economic releases as we've seen late, and the whole slew of economic releases that we've seen essentially throughout the month have been somewhat on the weaker side. I think particularly the market is starting to focus in on a fundamental basis, looking at the core of what moves the underlying economy, and that is manufacturing, industrial production, and housing. And you saw this morning particularly those numbers once again were weak, and the market, taking its cue from those weak numbers, is sitting on the low side. However, let's not forget that you are in the expiration mode. So you're going to have futures expiration, option expiration, equity option expiration, quad whichever you'd like to refer to them. You have ETF options expiring as well. The gamut of items are going to be expiring this Friday. So I don't know, in my gut, my sense of it is that we're not going to trade much lower than we've seen as of late. Some of the levels that you should probably be keeping an eye on, if you take a look at the action for this week based on last week, we actually have a week that's setting up that we could move forward on and create an outside week. I would like to see that personally, because I think that what we've done is basically come back and revalidated as near to unchanged on the year in the index, both in the NASDAQ and index I refer to the cash. So at any rate, here's some levels for you. The high side on the week, 92.5. The low side on the week, 65 even. Obviously, that takes out last week's, which was, and I'm again making reference to the cash, 1,326, closing out the week on the 10th. 68.28, closing out the week on the 10th, the low side. This week we've taken that out on the low side. We have not taken that out on the high side, but we all know how this market could move. Very easy, where this market going into expiration, where we could move 25 index points without a real problem. So you're kind of stuck in that little bit of a band. I don't mean to sound non-committal here, and that's why I say you could almost go either way on here, but I think the tilt is, because you're in expiration week, it's probably more so on the buy side than anything else. We've been back and forth in and around that 8-day moving average. 1281.19 is something you should be keeping an eye on. I know that a lot of traders are focusing, in both day traders, institutional traders, hedge fund traders, and the like. They're all looking at the 200-day moving average, which comes in just underneath. That 200-day moving average actually, on a simple calculation, is 1256.87. I don't necessarily think that you're going to see that. I think if the market backs off any further on any data that's even worse than what we've seen, I think that you would revalidate unchanged on the year. And I think one of the things that you want to keep an eye on is that the market's focus in terms of the global investor is that which is the uglier child. And by that I mean this. You have the issues in Europe with Greece, of course, and you have the debt ceiling issue in the United States that's rapidly approaching. So you choose which is your harder pill to swallow, if you will. The 30s have taken out a 30-40-day trend line, if you will, the 30-year bonds, that is 124.27. The 8-day moving average is 125, to keep an eye on that market. The dollar index, interestingly enough, is starting to develop a little bit of steam. So you're looking at the 8-day moving average in the dollar index, 74.28 on that, and the 100-day is 75.84. Personally, I think that the dollar starts to strengthen a little bit, 75.84, and if you go by the old standard that we've seen in the last, say, 6 months, a stronger dollar does not bode well for U.S. equities. So we would like to see a decoupling of that, and we have seen that in the past. At any rate, those are your levels. Trade smartly. Have a good day. This is Rich Canleone from the CME Group trading floor, signing off.